Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Wendy's, ticker symbol WEN. When I initially went into reviewing this company and doing the analysis, I thought that they would have a very strong balance sheet since they are a very mature company. I thought that it would be relatively very easy to kind of value. After I got into my DCF and started plugging the numbers in, it looks like Wendy's really is kind of a value trap with a large discount that it's selling for. The stock is down 13.98%. The market cap is $3.16 billion. The price to earnings ratio is 16.4, and the annual dividend yield is 6.45%. I think that it's hard to give a recommendation for Wendy's stock. Obviously, it's been down so much over the past year. If they can maintain their current level of cash flows, I think that this is a buy. But I think that you should take extreme caution with Wendy's because I don't really think that they're able to increase their revenue very significantly into the future or their cash flows. I think that this company isn't necessarily even defensive because if there's a recession, less people are going to want to eat out. I really don't see Wendy's being able to innovate in any way because of the company that they are. I don't think that there's a lot of places that it would make a lot of sense to put a new Wendy's at where there isn't already a Wendy's there. So I think that the business itself has significant problems moving forward, and the stock performance kind of shows that. Even though it does look like there's significant value in this stock, I think that we're going to see that it's probably best not to add it to your portfolio simply because even if you're getting in at a really cheap price, you're not getting any real growth into the future, and debt is a major concern, which we'll see later. Analysts overall pretty much have a consensus hold rating, with 2/3 of analysts rating it a hold and the rest either rating it sell, buy, or strong buy, with one rating it an underperform. Current analyst price targets range anywhere from $14 to $29, with an average price target of $17.30, which does predict some upside. But I really am going to be trying to make the case that despite the valuation, I don't think that you, or anyone really, should be just jumping into this stock because it's undervalued. I think that this is a value trap because it's not very monopolistic. It's in a very competitive industry, and there's not really a lot of growth in the future for this company. Because if you're not aware, the way that Wendy's corporate makes its money is a percentage of revenue from the franchisees. The only way to increase that amount of revenue is either to have the franchisees sell more, which I don't think is really possible personally, because I don't think that they're going to be able to drive more people to want to go to Wendy's consistently, or they can have more franchisees, which seems like the no-brainer option because then you're collecting from more people. But like I said before, I don't think it really makes sense to go that route either, because pretty much everywhere that possibly could have a successful Wendy's probably already has one. And we're also going to see that there's a significant amount of debt on the balance sheet, which is never a good sign. Here I have the weighted average cost of capital for Wendy's of 4%. This is because the cost of debt after tax is 2.16% and the cost of equity is 6.419%. However, one thing that's really interesting to note is that the total debt exceeds the entire market cap of the company, which is never a good thing when you're investing in companies. I know that they'll be able to pay off their interest payments, but this is definitely something that could hurt Wendy's in the future, and I personally don't like it when a company has significant debt on the balance sheet compared to their market cap for a number of reasons. Because if there's a bad economic time or a bad quarter or a bad year for Wendy's, this debt could absolutely crush them, and I would not want to be an investor in that situation. However, plugging that weighted average cost of capital into the model, we can see that currently Wendy's is selling at a deep discount. My model is showing that with 0% growth of the free cash flow over the next 9 years and a perpetual growth rate of 2.5% for the terminal value, there's 41.85% upside in buying Wendy's currently. And now we can see that the average revenue growth has grown 5.85%, that the average free cash flow growth rate has been 4.89%. So it's been pretty consistently growing at around 5%. I'm guessing that this debt is really hurting them, and just other expenses are hurting them as well. And again, there's a growth problem here. I mean, you could continue to grow in the short term, but I just don't see Wendy's as being like a quality company competing with McDonald's, competing with Burger King, competing with all these other big fast food restaurants, and coming out with an increased market cap in the future. And I kind of think that's where Wall Street is too. I think if you've already bought into this, it's probably fine to hold on, but I would not want to buy into this now. I think that it is below its fair value. I just don't see it moving in the right direction in the future. And that market cap is like, a fifth of where I thought Wendy's would be at. I thought that this would be a $15 billion company just because of how many locations there are and how mature of a company it is, because obviously Wendy's has been around for a really long time. But it seems like that their management is not doing the right things to make Wendy's bigger and make it more money, because if your company's selling at this deep of a discount, it's probably a value trap, especially because it's not monopolistic. Here are all my cons with Wendy's. I'll just lay them all out. The debt on the balance sheet is extremely high. I think that's the number one concern. I don't know how you solve the growth problem. I don't know how you continue to grow the restaurant chain going into the future and make the cash flows increase significantly over time. Overall, I just wouldn't want to add this company to my portfolio because it's not monopolistic. They have extreme debt, and I think that they have a growth problem. And I think that when you're investing, what matters more to me is the actual company itself rather than the DCF valuation. I think the DCF valuation gives you an idea of when to get into a company, and it gives you kind of like a last out if the company is overvalued to kind of see what range you would be comfortable buying in. But for me, I think that the financials are not good enough for me on Wendy's. I think that they have extreme growth problems going into the future. And I think overall the company is just very mediocre. So while I think that there is probably value in getting in now, over their past performance and just how Wendy's has gone, I would not expect the trend to go up in the long term. I would expect it to continue trading sideways or down, continue to trade at this massive discount, and not really provide a lot of shareholder equity. Let me know what you guys think in the comments section down below. And, hit the subscribe button if you made it this far. Check out my other stock analysis videos. Thanks for watching. Bye.